February 3rd, 2026. The Federal Reserve's emergency monetary policy session concluded with a decision that will fundamentally alter global precious metals markets forever. Classification Directive FMP 2026-003, authorized by unanimous Federal Open Market Committee vote, formally designated silver as a systemically critical strategic material, subject to emergency allocation protocols that supersede normal market mechanisms when national security requires prioritized distribution. The directive was not a response to market volatility or inflation concerns. It was the Federal Reserve's acknowledgment that silver scarcity had become so severe that normal monetary policy implementation was being constrained by physical material shortages affecting defense production, renewable energy infrastructure, and financial system stability. Silver had transitioned from traded commodity to strategic resource whose availability determined monetary policy effectiveness. Within 6 hours of the classification announcement, silver prices exploded from $74.30 to $97.80 per ounce, as algorithmic systems processed the implications of government recognition that silver availability had become a national security constraint. But the price movement was secondary to the structural transformation that the classification represented. Silver markets would no longer operate through normal supply and demand, but through government allocation priorities. The classification directive authorized Federal Reserve coordination with the Department of Defense, Department of Energy, and Treasury Department to establish strategic silver allocation protocols that would ensure continued production of defense systems, renewable energy components, and financial infrastructure that required silver inputs regardless of market price levels. Private silver ownership would be subordinated to strategic requirements during declared emergencies. The decision was based on classified assessments indicating that silver inventories at COMEX, London Bullion Market Association, and Shanghai Gold Exchange had fallen to levels that threatened continued operation of industrial systems essential for national security and economic stability. Government analysis concluded that silver scarcity represented systemic risk that required emergency intervention beyond normal market mechanisms. Yet the most significant aspect was what the classification revealed about the extent of America's strategic material vulnerabilities. Silver had joined uranium, rare earth elements, and critical semiconductors as materials whose availability determined national capabilities rather than commercial opportunities. The age of abundance that had characterized American industrial policy for decades was ending with mathematical precision. The Federal Reserve's silver classification represented the culmination of 18 months of accelerating industrial demand that had collided with mining production constraints and financial market manipulation that obscured the magnitude of physical supply deficits. Silver consumption had been growing at 23% annually, while mining output remained flat, creating mathematical certainty that available inventories would be exhausted within months rather than years. Industrial silver demand had reached levels that made price secondary to availability as electronics manufacturers, solar energy developers, and defense contractors competed for supplies essential for production systems that could not operate without guaranteed silver access. Electric vehicle production alone consumed 89 million ounces in 2025, while global mining provided only 847 million ounces total, creating competition between sectors that had previously assumed unlimited silver availability. The COMEX silver inventory had fallen from 124 million ounces in January 2025 to 23 million ounces by February 2026, representing the fastest precious metals inventory decline in exchange history. Daily delivery requests exceeded available silver by margins that forced cash settlement rather than physical delivery, revealing that futures markets had become disconnected from physical reality through derivative leverage that created artificial supply claims. Central banking analysis had concluded that silver scarcity was constraining monetary policy effectiveness because defense production, renewable energy development, and financial system infrastructure all required silver inputs that market mechanisms could not guarantee. Federal Reserve officials faced recognition that monetary policy implementation depended on strategic material availability that market forces alone could not provide. European central bank coordination with Federal Reserve silver policy reflected international recognition that silver scarcity threatened Western technological capabilities and economic competitiveness. Joint central bank analysis indicated that silver availability had become constraint on economic growth that traditional monetary policy tools could not address through interest rate manipulation or money supply expansion. Chinese strategic silver accumulation had accelerated throughout 2025 as Beijing recognized opportunities to gain technological leverage through resource control, while Western central banks focused on inflation management rather than strategic material security. People's Bank of China silver reserves had increased by an estimated 340 million ounces, while Western inventories contracted, shifting global silver control toward authoritarian governments. Government intelligence assessments indicated that adversarial nations had been systematically accumulating silver reserves, while Western policymakers treated silver as financial asset rather than strategic material. The intelligence revealed coordinated resource acquisition strategies that provided foreign governments with leverage over American industrial capabilities through material scarcity rather than military pressure. Corporate supply chain analysis had identified silver as single point of failure for multiple critical industries, whose production could be halted by supply disruption, regardless of available capital or manufacturing capacity. Defense contractors, technology companies, and energy developers faced potential shutdown scenarios that financial hedging could not prevent when physical silver became unavailable at any price. The Federal Reserve's silver classification was triggered partially by Department of Defense assessments, indicating that weapons production, radar systems, and communication equipment faced potential manufacturing delays due to silver component shortages that could affect military readiness during periods of international tension. Defense contractors reported that silver procurement had become more challenging than securing classified technologies or rare earth elements. Raytheon Technologies, Lockheed Martin, and Northrop Grumman had escalated silver supply concerns to Pentagon leadership after experiencing delivery delays and price volatility that threatened defense contract fulfillment. Military electronics required silver components that met strict performance standards that alternative materials could not satisfy without extensive testing and certification processes requiring years to complete. Strategic weapon systems, including missile guidance, satellite communication, and electronic warfare equipment, depended on silver's unique electrical and thermal properties that made substitution impossible without compromising performance in ways that could affect mission success and personnel safety. National security had become dependent on silver availability that market mechanisms could not guarantee. The Defense Production Act was activated to prioritize military silver allocation, but Pentagon officials discovered that total available silver inventory was insufficient to satisfy both defense requirements and civilian industrial demand. Strategic material scarcity required allocation decisions that would affect either national security capability or economic productivity, regardless of budget availability or political priorities. Renewable energy, infrastructure, breakdown. Solar energy development faced immediate constraints as photovoltaic panel production required silver paste that was becoming unavailable at sustainable prices despite government subsidies and renewable energy mandates. Clean energy transition policy depended on silver availability that market forces could not provide within timelines that climate commitments required. Utility companies with major renewable energy investment programs encountered silver supply problems that threatened their ability to meet state renewable portfolio standards and federal climate objectives. Next Era Energy, Brookfield Renewable, and Ørsted suspended project development while attempting to secure silver supplies or develop alternative technologies that could replace silver-dependent systems. Energy storage systems essential for renewable energy integration required silver components for optimal performance and safety characteristics that alternative materials could not replicate without reducing efficiency and increasing fire risk. Grid-scale battery installations designed to stabilize renewable energy output faced material constraints that affected energy transition implementation regardless of policy support or funding availability. The Environmental Protection Agency faced recognition that climate policy implementation required strategic material coordination that traditional environmental regulation had not addressed. Clean energy development was being constrained by resource scarcity rather than technical feasibility or economic viability, requiring government intervention that environmental agencies lacked authority or expertise to provide. Financial system infrastructure, vulnerability. Banking sector analysis revealed that financial system infrastructure, including data centers, communication networks, and transaction processing equipment, required silver components that were essential for system reliability and security. Federal Reserve officials recognized that monetary system operation depended on strategic materials that central bank policy could not control through traditional tools. Electronic payment systems, automated trading platforms, and financial data transmission required silver-containing components whose availability affected banking system stability during periods of supply disruption. Financial system resilience required strategic material security that banking regulation had not addressed as systemic risk factor. Insurance companies faced potential claims from business interruption policies as silver shortages affected industrial production across multiple economic sectors simultaneously. Policy coverage for strategic material shortages was undefined in existing contracts, creating legal uncertainty about financial system liability for resource scarcity rather than traditional business risks. Credit markets reflected investor concern about industrial companies whose production capabilities were constrained by silver availability rather than capital access or market demand. Corporate debt pricing incorporated strategic material risk assessment that had not previously been considered relevant to credit quality evaluation. International economic disruption. European Union coordination with Federal Reserve silver policy reflected recognition that strategic material scarcity was affecting Western economic competitiveness relative to nations with greater resource security. Joint policy development addressed silver allocation priorities that required international cooperation while maintaining alliance solidarity during resource constraint periods. Chinese silver market strategy appeared designed to exploit Western supply chain vulnerabilities by restricting exports while accumulating strategic reserves that provided Beijing with leverage over Western industrial capabilities. Trade relationships were being restructured around strategic material access rather than traditional commercial considerations. Middle Eastern sovereign wealth funds accelerated silver acquisition programs as regional governments recognized opportunities to gain influence over Western economies through resource control that oil market manipulation had historically provided. Strategic materials were becoming tools of economic statecraft that affected international relationships beyond traditional energy or trade considerations. International organizations, including the United Nations and World Trade Organization, faced pressure to develop frameworks for managing strategic material distribution during scarcity periods. But existing institutions lacked authority or expertise for coordinating resource allocation that required technical rather than diplomatic solutions. The moment of irreversible transformation occurred when Federal Reserve Chairman Jerome Powell announced during the February 3rd monetary policy briefing that silver market conditions had reached levels that required immediate implementation of emergency allocation protocols to ensure continued operation of critical national infrastructure and defense systems. The statement marked the end of free market silver distribution and the beginning of government-controlled strategic material allocation. Powell's announcement was accompanied by Executive Order 140156, which authorized federal agencies to requisition private silver holdings, suspend normal commodity market operations, and implement strategic allocation priorities that subordinated commercial demand to national security requirements. The executive order established legal framework for government control over strategic materials during declared emergencies. The European Central Bank issued coordinated statements indicating that Western central banks would jointly manage silver allocation to ensure continued operation of alliance defense capabilities and economic infrastructure. International monetary policy coordination expanded beyond traditional currency and interest rate cooperation to encompass strategic material distribution that affected national capabilities rather than just economic performance. Chinese responses to Western silver allocation policies revealed the extent to which Beijing had been preparing for resource-based economic confrontation with coordinated strategic material restrictions and alternative supply chain development. The conflict had escalated from trade disputes to resource warfare that threatened technological capabilities and industrial capacity on both sides. The Federal Reserve's silver classification established precedent for government intervention in strategic material markets that could be applied to lithium, rare earth elements, and other resources essential for national security and economic competitiveness. Free market ideology had been subordinated to strategic necessity when material scarcity threatened capabilities that governments could not accept degradation of. Congressional emergency sessions addressed strategic material vulnerabilities that threatened American industrial capabilities and alliance relationships. But legislative solutions required years of implementation, while silver scarcity created immediate constraints on defense production and infrastructure development. Political responses were inadequate for addressing resource dependencies that required industrial and technological capabilities rather than policy modifications. 3 months after the Federal Reserve's silver classification, precious metals markets operated under permanent government oversight that had fundamentally altered the relationship between strategic resources and economic policy. Silver prices stabilized above 150 US dollars per ounce as government allocation priorities superseded market mechanisms for determining distribution and pricing. The transformation had revealed that modern economic systems required strategic material security that market forces alone could not guarantee when resource scarcity threatened capabilities essential for national security and technological competitiveness. Silver had joined other strategic materials whose availability determined government policy options rather than commercial opportunities. Federal Reserve monetary policy had evolved to incorporate strategic material constraints that affected policy implementation capabilities rather than just economic conditions. Central banking required coordination with defense, energy, and technology agencies to ensure that monetary decisions supported strategic objectives rather than purely economic targets. American industrial policy had been restructured around strategic material independence that required government coordination and investment rather than market optimization. Corporate strategies reflected recognition that resource security was essential for operational continuity that financial management alone could not provide. International relationships had been transformed by resource-based competition that operated through strategic material control rather than traditional trade or military pressure. Alliance cooperation required sharing of strategic resources while maintaining competitive advantages that resource endowments provided. The silver market had become proxy for broader transformation in the relationship between government authority and economic management, when strategic necessities required coordination that market mechanisms could not achieve. Resource scarcity had forced recognition that economic freedom was constrained by material realities that policy could influence but not eliminate. Silver pricing above $150 per ounce reflected permanent premium for strategic material access that incorporated geopolitical risk and government allocation priorities rather than just supply and demand fundamentals. Precious metals. Investment required understanding of strategic considerations that extended beyond traditional financial analysis. The Federal Reserve's silver classification had established framework for managing strategic material scarcity that would be applied to other resources as technological advancement and resource depletion, created similar constraints on economic and national security capabilities. Government intervention in strategic material markets had become permanent rather than emergency measure. The transformation marked the beginning of resource-constrained economic management, where government priorities would determine material allocation during scarcity periods that market mechanisms could not address effectively. Strategic material policy had become central to economic governance, rather than peripheral consideration. Silver had completed its transition from traded commodity to strategic resource, whose availability determined national capabilities rather than commercial profits. The age of market-determined precious metals pricing had ended, replaced by government allocation systems designed to ensure strategic capability rather than economic efficiency.